Hey everybody, Happy New Year, Happy 2026, super excited, not only because this is the first episode of the year, but because I have a returning guest. And yes, this week, he's gonna be asking me all the questions, so please tune in. We have Thomas Itemere from Century 21, office based out of Auburn, Massachusetts, works all over the state, so please tune in, like it, comment, share, subscribe, and let's talk some mortgages. All right, so please make some noise, take out them fireworks, blow them horns, because we have my good friend, real estate agent Thomas Itemere. Let's go!
Well, Sebastian, always a pleasure to be here. Thank you so very much for having me. I hope you enjoyed the holiday season. How's the new year treating you so far?
You know what? Thank you for asking, Thomas, and thank you for coming, man. I appreciate it. The New Year's was great. It was a lot of good time, family bonding, a lot of good time spent with the family. It's incredible how quickly 2025 went by, but I feel really good about 2026, and there's some very good insights and good news on what's going on in the mortgage world and in the real estate world as well. Right? So, Thomas, thank you so much for coming. I know this is the second time you've been on.
This is.
Right? So we had to have you back on because I've been seeing how hard you work all year, how you've been trying to, communicate all this good information, valuable information to home buyers or even sellers, right? And I know you have a lot of good questions and a lot of actually important questions that you want to get out and make sure your clients and your borrowers are well informed, right?
Right, Sebastian. Well, as you heard, as Sebastian said, my name is Thomas Itemere, and I'm a realtor. I'm based out of Central Mass with Century 21 XL Realty. We're out of Auburn, Massachusetts. And for today, us as realtors, we're sometimes the first line of defense when these buyers come to us because, they don't understand some of the components that we as realtors have to be sort of a conduit for all these professionals in the industry. Mm-hmm. So for what I would like to accomplish today is I do have a series. It's not many questions, Sebastian. It's not too many questions. But I got 1 or 2, 3 questions that normally a lot of people will come my way, and normally I'll deflect them to a guy such as yourself with that professional knowledge and with an educated responses.
Love it. Thank you.
So one of the biggest questions that everybody starts off with, how do I know what I can afford and what's going to cost me?
That's a great question, Thomas. And I'll tell you, so the question is, how much home can I afford and how much is that monthly payment going to be and how we get to that point, right?
That's
so
right.
It's very simple, right? So how we determine how somebody can purchase, it all comes down to debt to income ratio, right? So aside from the credit score, the employment history, which is going to tell us first if you can qualify, it's really down to the monthly income where it's going to tell us how much of that monthly income you can put towards a mortgage payment. Okay, depending on the credit score, if you have a good credit score, you're going to be able to have more options and get into loan programs. That's going to allow you to put the most amount out of your monthly income towards a mortgage payment. It's all percentage-wise, right? So I'll give you an example. FHA, front-end debt-to-income ratio, can allow you to go up to 45% debt-to-income ratio. It's a percentage, meaning 45% of your monthly income can go towards that mortgage payment. Okay? If we're looking at other programs, because you have a high credit score, you have low debts, conventional loan might be a better option for you. That's going to allow you to go to 49.999% of your debt to income ratio. What does that mean? 49, almost 50% of your income, your monthly income, you can put towards a mortgage payment. So if you're generating $10,000 of monthly income, that's a $5,000 mortgage payment you can sustain. That, depending on the purchase price, real estate taxes, and the homeowner's insurance, you might be looking at around $600,000 purchase price, right? Okay. So very important, like you said, purchase price is important, but the monthly payment really is the most important factor that's going to dictate and tell us how much purchase price you can actually get up to.
All right, that's fantastic. Now, another scenario that has been presented to me multiple times is, so now, thankfully, the client has come your way, you have pre-approved them, and now they start looking at all these different products. And first and foremost, let me touch on the multifamily, whether it be a 2-family, 3-family, 4-family.
Yes.
How do those rents influence the approval for particular client?
Love the question because like we just spoke about, right? Debt to income ratio, where if you're looking at a single family home, we're only looking at your monthly income and compared to this mortgage payment. Okay. Now, if we're looking at a multifamily, I'm going to be able to use not only your monthly income, but plus 75% of that future rental income that you're going to receive from that second unit, that third unit, or that fourth unit, or all the above, right?
Okay.
So it's going to increase the purchasing power because now we have more monthly income that we can play with, increasing that percentage of 49.99% to a higher monthly payment amount. If you're generating $10,000 a month, but now with that future rental income, now you're at $15,000, just an example, that monthly income that you can sustain now is higher. That purchase price, that's also higher.
Okay.
So very important, and it all works together. It's important when you work with a realtor and the loan officer together because the purchase price is important, but the monthly payment is really the most important.
All right. Now, another one is we're not, keeping in the multifamily. Now, I'm not an appraiser. However, sometimes we have a situation whereby I have an individual, they want to sell their property. It's a multifamily. And let's say, for example, a multifamily down the road sold for a certain dollar figure. And they anticipate that their multifamily should sell for that dollar figure. However, I try not to get into the details of it too much. However, we have, I've heard of this word get thrown around called a sustainability test. Kindly just elaborate on that and shed some light on what that really means.
Yes. So the self-sufficiency test, right? Is that what you're referring to? So the self-sufficiency test, what that means is if you're purchasing a 3-family home or a 4-family home and you're purchasing it with an FHA loan,
Okay.
not conventional, FHA, it means that 75% of the total rents, so of all 4 units, of all 3, or of all, not 2, if it's only 3 or 4, 75% of all 3 units or all 4 units have to come in higher than the mortgage payment.
Okay.
Now, what are we seeing a lot in the market is a lot of FHA loans are not passing with a 3-family home because it's not passing the self-sufficiency test, meaning 75% of all 3 rents is now coming in higher than what the mortgage payment is going to be. Why? Purchase prices are higher, interest rates are higher. Some of the rents might be lower, right? Maybe these tenants have been living there for 10 years and they just have a good deal and they've just been good tenants. So they're below market rents, which wouldn't allow us to pass the self-sufficiency test, right? So that's why it's very important to kind of reiterate is work, please, with the local real estate professional, with your loan officer, so that way when you look at every property, you're looking at the numbers. What's the mortgage payment? How much rents are we receiving? And can you really qualify for that home?
Okay. Now, another issue that I'd like us to touch on as we're talking about different properties. Now, taxes, property taxes is something that I always try to inform my buyers that taxes are based on a 12-month period.
Yes.
Not necessarily the entirety of the loan. And sometimes that does influence a lot of your payments.
Yes.
However, now, I'd like us to touch on condominiums. The condominium fees, as on my part of the world, they may, take care of things like snow removal, landscaping, exterior maintenance of the home. And these tend to vary. They could be anywhere from $50 to $1,000.
Yes.
Now, kindly just elaborate on how that would influence a particular buyer that you have approved with a certain dollar figure, and they're looking at a condominium that is within their guidelines, but for whatever reason may just not be the product for them.
So, Thomas, that's a great question because what we're looking at again, and then we're going to go back to the debt to income ratio, right? It's all about the monthly payment. Okay? Because we can look at 2 properties with the same purchase price, right? We say, hey, listen, buyer, you qualify for $500,000 home, $5,000 of a purchase price. We have 2 examples. Property A is a single-family home. Property B is a condo.
Yeah.
Same purchase price, right?
Correct.
But the monthly payment on this condo is going to be higher. Why? You just mentioned it. The condo fee. There's something that's called an HOA, right? It's for a condo fee if you have an association which maintains and takes care of the exterior of the property, like you said, the grass, the landscaping, the salt, the ice, the snow, right? So in regards to that piece, it's very important, right? Very important for you to be able to sustain and understand what this condo fee is and how much this condo fee is now going to affect the monthly payment. Okay, so when we're looking at these 2 properties, $500,000 home, this monthly payment, let's say, is $3,000, example, with no condo fee.
Okay.
And it includes the homeowner's insurance, real estate taxes, the principal, and the interest. Now we have property B, condo, same taxes, same insurance, but now it has a $450 condo fee to take care of the exterior. This is going to increase your monthly payment, which is now affecting your debt to income ratio.
That's correct.
So now we're looking at going from 49% DTI with a conventional loan without any condo fee, right, to now going down to increasing the monthly payment with this condo fee and limiting you now to a lesser purchase price because this debt to income has been affected. So please, yeah, very important. When you're looking at a condo versus a single family, let's look at the condo fee because that condo fee is going to add an additional monthly payment to your mortgage payment, which is going to reduce your purchasing power.
Fantastic. Now, we've talked about these three products, single family, multifamily, and condominiums. Now, I'm sure everybody out there is thinking, now, how do I know what I qualify for in terms of, you mentioned, I think FHA is somewhere there, you mentioned conventional. Now, how does one arrive at either qualifying for FHA, conventional, or better yet, if there's any down payment assistance programs out there, how do those come into play when it comes to purchasing?
So phenomenal question. The way we do our pre-approvals, right, is we look at the different factors, which is the credit score, right? Very important. It's going to tell us what kind of an interest rate, how many programs you have. Employment history, very important that we have you're working now and then you have your 2-year job history, right? Now, based off of the income, your monthly income is we're going to determine how much you can actually purchase, right? Okay. And it all comes down to this debt to income ratio and how much income you're generating, okay? And so remind me the question one more time, Thomas, is?
Well, how does a buyer know, number
Which
one,
loan program?
Know what loan program that they qualify for?
Okay.
And also, should there be any grants out there, whether they need it or not? How do they know about those grants, and how does that apply as far as for them specifically qualifying for these programs?
Based off of the factors I just mentioned, right? Now we're going to look at the different programs to see what's their best option. So I'll explain briefly why maybe an FHA loan program is the better option for you, right? So an FHA loan program is going to be more flexible with the buyer. What does that mean? It means that you can have a lower credit score, right? You can have 580 credit score, 600.
580, huh?
580 is, it's one of the lower scores that we can accept. And
you heard it, 580.
Yeah, 580, yep. If we can help you increase the score a little bit, we have a great system, Credit Simulator, that's going to help you increase that purchasing power, right? And your interest rate with a better option. But my point is that, an FHA is very flexible with the borrower. So if you have low credit scores, if you have high debts, so your debt to income ratio is really going to be high, it's going to be more flexible with the borrower. It's going to allow you to purchase the maximum amount, having low credit and having a lot of debts, okay? And putting only 3.5% of the purchase price as a down payment, whether it's a single, a 2-family, a 3-family, or a 4. Just has to pass the self-sufficiency test. Okay. So FHA, flexible with the borrower, but then it's very strict with the property, Thomas. So it wants to make sure that you're not purchasing a hole, right? No peeling paint. All the handrails are there. The roof isn't missing, right? The foundation isn't cracked. All the flooring is there, right? So it's going to be more strict with the property, but flexible with the borrower. Where conventional loans, why would you want to go with a conventional? 2 different options, depends your scenario, but a conventional might have a better interest rate or a better PMI rate, which can help influence how low of a monthly payment you're going to have. But conventional is the other way around. So just to kind of put it in very simple terms, conventional is more strict with the buyer.
Okay.
Wants higher credit, wants lower debts. Okay. More strict. You have to be more qualified. But then it's more flexible with the property. It kind of works reverse, right? So peeling paint's okay. Obviously, you don't want holes in the roofs or in the floor, but it's going to be a little bit more flexible at the FHA. So that's where you're going to compare and see which is the best option. Last one, down payment assistance. We do offer down payment assistance. There's a lot of down payment assistance with different towns and cities that you're looking to buy in here in Massachusetts, but there's Massachusetts Mass Housing Program. So any lender that's associated with Mass Housing, they have down payment assistance, $25,000 or $30,000, right? It really comes down to your credit, your income, what type of property you're looking to buy, and then your household income, because if you make too much income within everybody in the household, you can't get that free grant money. You'd have to get the down payment assistance, which is the second mortgage. Good and bad, down payment assistance helps you get into the home, no down payment. You can even include the closing cost in there. But the bad thing is obviously the cons is that it's going to limit you to a lesser amount. You do have to live in there for 30 years. So if you decide to sell or refinance before, you do have to pay the grant or the down payment assistance back, right?
Well, now let's touch on more on the down payment assistance. Now,
Mm-hmm.
I know that for most of my buyers, while we're in the process of shopping and this, that, and the next, you know, if their pre-approval, as you rightfully put it, is based on them having an income.
Mm-hmm.
Um, so now, if you have approved me and I'm taking care of a certain down payment assistance, I know sometimes we talk about situations where, unfortunately, if somebody loses their employment, of course, that would affect them in a negative kind of way. However, could you touch on, say you've approved me and and I have this down payment assistance, but it's based on my income.
Mm-hmm.
How does that affect me if my income changes for the better
Mm.
while I'm going through the transaction before we close?
Oh, love the question. So it's a double-edged sword, right? So it's the more money you earn, okay, the more purchasing power you're going to have. So the higher home you're going to be able to purchase, as long as you can sustain that higher mortgage payment, right? So that's one thing you need to really weigh is how much you want to purchase and how much you can qualify more important, or do you really need that down payment assistance? Is that something really important? Because yes, if you earn more than that limit, okay, and it's a household limit. So if you're married, if you have kids, and if your kids work and if your wife works, well, that's taken away from the limit, right? If they don't work and they're dependents, well, that's good because now we're only looking at your income. So you're only basing off your income based off of a 5-person household, okay? Higher limit than you only going in there with 1-person household, lower limit, okay? So if you go over your limit, yes, you wouldn't be able to purchase with this $30,000 free 0% interest rate forgivable grant. Okay, it's a down payment, but it can be forgivable after 30 years. If you earn more than this 80% area medium income, now you get categorized into the $25,000 down payment assistance, second mortgage. It's actually 15 years for 2% interest rate. The monthly payment is about 160.88 cents. So about $161 a month on top of your mortgage payment. Sounds good and all, but it's going to limit you to a lesser amount. If you can put a little bit of money down in that minimum down, it's going to help you purchase the maximum amount that you want to get into.
I often say if you can help yourself a little bit, because sometimes you got to remember it's a loan. If you can assist yourself a little bit, it's overall a better situation for you, the borrower.
Yep.
Now, one last question that I would like to touch on here. Now, what kind of upfront costs should most buyers think about, before they come speak with you?
Love the question. Yep. Sorry to cut you off, Thomas, but I'm excited about this question because we have down payment assistance programs, right? But that doesn't mean that you don't have to have nothing in your bank account to purchase the home because there are some upfront costs, like you mentioned. One of the most common ones, and again, it's not required, but it's definitely recommended, is the home inspection. Okay, we as the bank or any lender we do not require for you to go and get a home inspection. Okay, that is for you, for your own purposes, to invest a little bit of money to make sure that you're purchasing a solid home and that if it does need repairs, how long do you need to expect for them to get repaired, right? How long are they going to last? Or, hey, do I need to expect a big surprise in the next couple of years, right? Or maybe it gives you some negotiating power, which you can more talk about. But aside from the inspection, the appraisal. So the appraisal is something that's already included in the closing costs, right? So random number, let's say if we say your closing costs are $7,000 and you're buying a multifamily, so the appraisal cost might be, let's say, $800, okay? Well, if you've already paid $800 up front, okay, and the closing costs are $7,000 at the closing table, well, you're just gonna subtract the $800 you've already paid up front. So you're only bringing $6,200 at the table because you already paid this up front.
Okay.
Appraisal is very important, man, because that's how the bank is going to determine whether the collateral, the property that you're purchasing, is really worth what you're buying, what the purchase price is on contract for, and whether it makes sense for the bank to invest in that property, right?
Now, I like that you bring that up, and while you're speaking, I was just thinking about that in my head. A lot of questions that I've also heard out there is, okay, you have a situation whereby, a client looks at a home, they absolutely love it, and you have a situation where it's a multiple offer situation. And, obviously you have a buyer that they want to present, and, I will advise the buyer to present as attractive as offer as I can. And at some point, price may be an addition to that attraction. But a lot of people push back and they say, well, I don't want to pay for more. I don't want to pay for this house for more than it's worth. So now you've gone through the offer process and we've been selected. And now here we are, and the appraiser comes out, and lo and behold, the property comes less than what we put or what we wanted to purchase it for. The appraisal came for less than that dollar figure. How does that influence, or how does that work? Please,
Great
shed
question.
some light on that.
Yes. So us as the bank, just going back to think about it as if you were to invest or lend somebody money to purchase something. Right?
Yeah.
You want to make sure that something is worth what you're purchasing it for.
Well, you want to make sure it's there. That's what I tell people. It's got to be there.
It's got to be real. It's got to be there.
We're selling real property. It's got to be there.
It's not no what's it that virtual stuff? Bitcoin stuff. No.
They're not Bitcoin. It's there. It's tangible.
It's physically.
It's real estate.
But the most important piece, Thomas, is first knowing that it's there, like you're saying, that it's real, but then determining, what this purchase price is going to be,
Correct.
Right? And then what the value is going to come in. But then more importantly, if the value comes in lower, this is where it's very important to have a good team. Okay, so I'll explain. Us as the bank, we want to make sure that what you're purchasing is valued to what you're purchasing, right? That's it's a most important piece. If the value comes in lower than what you're in contract for, us as the bank, we're gonna lend you what the maximum value is on the home.
Okay.
Options, yes, there are options for you to rebuttal. So you have a good realtor. We can send what's called a rebuttal. So we send other comps that have been, other comps of that same property that have been sold within 1, 2 miles or 3 miles max of that subject property in the past 6 months.
Okay.
So that way we say, hey, appraiser, look, no, these other homes have sold for this purchase price and they're identical. Let's rebuttal. Let's reconsider this value, right? So that's one option. We can always push back. We can always fight. If that doesn't work, then what do we have to do? We work with this, professional and the man of the hour, the realtor. And Thomas, you go and you negotiate. Hopefully, if you can bring this purchase price down from what you guys agreed on down to this value that officially is on paper, then now you're going to be able to purchase this home that you're in contract for a lesser purchase price, lowering all the numbers, the down payment, the monthly payment, closing costs, interest rate, everything, not the interest rate, but the total cost of everything lowers, right? So that's very important. It's a matter of seeing if the value comes in lower, the deal's not dead. It's just a matter of negotiating with the seller to make sure that they're still happy and that you guys don't lose the deal. Now, what happens, a lot of people get nervous and they say, well, what if they don't accept it and they don't want to drop the price down? Well, guess what? They're going to put the house on the market. Somebody else is going to go do another appraiser, and the appraiser is going to say, oh, wait, there was an appraiser that was done 2 months ago. What'd that value come in at? Oh, I don't see much of a difference, same value. So the listing, the seller is almost going to get not stuck, but that's the value of the home at that time they did the appraisal.
Okay.
So it's a way for you to negotiate and hopefully lower the purchase price. Yeah.
So now, and just to stick with this just for a quick moment. Now, for me as a realtor, if we've already gotten to that point, as part of your inspection, as we touched on earlier, your homeowner's inspection cost is also factored in to your closing costs. And you've already spent these monies for that home inspection. And I know that, if a situation comes about whereby, for whatever reason, we don't come to a meeting of the minds as far as the value goes, and we have to, pull back from this deal, I normally advise my clients that they may not retrieve the funds that they used for the inspection because that's already gone. However, the lender is the one who applies and sets up the appraisal.
Yep.
How do those costs impact the buyers?
Yeah, so that's a great question. So let's say, for example, you pay for the appraisal, and that's upfront, right? That's not meaning that the deal has been approved, that you've been approved, or that you're going to the closing table. So yeah, if the value comes in lower, if the deal falls apart, that's a true cost out of your pocket as a buyer or any, think about as an investor, your first home. That you won't get back. It's a true cost that's gone out of the window. Now, the good thing that is if you continue to work with us, all right, we're good people. We're here to help, right? So you've already paid for one appraisal. We're going to give you a lender credit. So we're going to work towards giving you a lender credit. So the next appraisal you pay for, because you have to pay for the next appraisal, right? If you buy the next property, You see a new property, you got to get a new appraisal. We're going to give you a lender credit to help you and offset this new payment. But
Oh, that's fantastic.
so yeah, we're here to help, man. Absolutely.
Cool deal, cool deal. So far, I haven't had any credits for the inspection part of things.
Not yet.
But, we try to help them out in that regard. And now, so now here we are, and the property's been appraised, and now we're going through underwriting. Touch on that. What does that process entail? Because sometimes,
Yeah.
it just kind of touch on that, if you will.
I'll explain it, man. So
leading up to the closing table,
yeah, I'll explain it, man, because it's a long process, right? It's a long process, and some people get lost halfway through, or they feel that maybe the loan has been forgotten about and nobody's working on it. But I'll explain the true process of a mortgage, right? It's a team effort, right? It's a team effort. I'm not the one that starts it and brings it to the end of the table. I start the loan. I make sure you qualify. I make sure that everything that when it gets to the underwriter, it's going to get approved. So that's my job, almost like an underwriter, pre-underwriter, to make sure when it gets to the underwriter, it gets approved, right? But my job is really to make sure that first you qualify, and if you do qualify, present you all the different options. So you're going to make sure and you understand which loan program is the best option for you. Once you get these options, because we've already been pre-approved, we've already gone through asking you for documents, making sure you qualify, almost underwriting you, right? So to answer your question, Thomas, by the time you get to an underwriter, it's because we've already done our due diligence up front. You made the offer, they accepted the offer, you did an inspection, you did the appraisal came in good. File after all this time, right, since we've done the pre-approval, now I have to ask you for updated documents. This is normal, and we're going to continue to ask you documents until the closing table, up until maybe an hour before.
So you're going to call my employer at 9 a.m. the day that I'm closing
if we
to
have
find
to,
out if I'm
you know
still
what?
employed?
And unfortunately, yeah. So during COVID, actually, that's something that got implemented where, if you lost your job that day or the day before, and we called and hey, no, they lost their job. Unfortunately, everything gets shut down. Your deal will fall apart and everything gets put on pause, right? So very important for you to, from the beginning of your pre-approval until you sign those papers, the credit, the income, the assets, everything that we have pre-approved you on stays the same or has gotten better by the time we get to the closing table. So when it gets to underwriting, it's always, because we do a good job, it gets conditionally approved.
Okay.
Right? We're never in the business to get it denied. We're in the business to get it conditionally approved. Conditionally approved means that it's approved with the following conditions: new pay stubs, new bank statement showing the deposits coming out, an explanation on your credit. Things that are simple to get and not impossible to get to kill the deal. No, now it's just gathering the last piece of documents that the underwriter needs to get those magic words, that clear to close.
Now here I am. I'm so excited. I found a dream home, and my emotions are just running high, and I'm gonna be closing sometime at the end of the week. And I'm just imagining all these beautiful things I want to do to my home. And I step into this furniture store, and I see this stuff that I know I can afford it, because I can afford it. I know what my capabilities are. And the guy at the counter tells me, well, it's 0% for so long. And he says, why don't we do an application right now? Thereby, I'm not taking any money. I'm not taking anything yet, but they want me to get, some sort of line of credit in preparation to before I close, after I close, to have this wonderful furniture come to deliver to my house in a timely fashion. What's your advice on in that situation?
Man, I wish I had superhero powers at that time. So I'd sense it, and I would appear right next to you, and I'd slap you in the back of the head. Listen, it's very important what I'm telling you. Please do not mess with your credit, your income.
But
your debts.
I'm not doing anything yet.
Okay.
I'm not gonna buy it yet. The guy just said he's gonna take my social security number and run my credit just to see if I qualify. I know I qualify. I got an 800 credit score. I know I qualify.
I know you do, my friend. But
why is that an issue?
it is an issue because what we look at, and this is a very, it's the biggest investment of your life. So think about it as if you were to invest somebody hundreds and thousands of dollars. You're making sure everything lines up until the very end. So if for any reason, and we monitor everything, if we see that you pulled your credit, whether you're preparing yourself for 2 or 3 months down the line, that's going to hurt your credit score. Hopefully it doesn't ding it too much. So that could affect the what we already have approved for you. And then the underwriter is going to ask, did you open up any new line of credit?
Oh.
If you did, explain to us when we have to ding you with this new balance, right? So it can definitely throw things off while, our recommendation is just hold off a little bit, right? Just it's not gonna kill you for you to just be able to wait until you close the deal, get those keys in your hands, sign, and then you can go and, furniture the whole house if you want to. But just hold off, right? It's very important because we're monitoring everything. Credit, number one, your income, employment, and then your assets. We're also looking at till the closing.
How about a Home Depot card? I mean, I'm about to be a homeowner. I want to get the assurance that, heaven forbid, should something break in this property, I have a line of credit from Home Depot that I can take advantage of. What do you think about that? Is that the same as well or no?
Well, that's the same thing. Well,
or any one of the big box in home improvement stores.
That's where my superheroes come in. My powers come in. I come in and I appear right next to you and I slap you in the back of the head. Right? No, man, it's the same thing. So it doesn't matter if it's a Home Depot, Lowe's, even if it's a secured credit card, or maybe if it's something that's, a credit booster, anything that's going to affect your credit, we're going to look at it and we're going to ask, and we're going to need explanations and documentations if you did open something. So yes, please just work with your professional, with your lender, with your realtor, and any decision, any question, any doubt, concern that you have. Hey, I want to open up this new line of credit. Jordan's Furniture is offering these new deal. Talk to your professional, because they're going to guide you and give you that advice that's going to help you get to the table and not prevent you from getting to the table.
Folks, you heard it from the horse's mouth. Don't do anything.
I heard a horse.
Now, I've been asking all the questions, Sebastian. I mean, do you have any questions for me?
Yes, man,
I mean,
absolutely.
I feel like I came and took over your show. They should put my name right there.
Yeah, no, this is, thank you for having me on your show, Tom. I appreciate it, man, because there's a lot of good information, a lot of questions that I know you get, and thank you for sharing that with me, and hopefully we can share it with the audience and have them learn from it. So reach out with any questions. But now let me switch the table really quickly, because I know these beautiful people do have to go. But okay, Thomas, we've got somebody pre-approved. I've done all my due diligence. I got my superhero powers on. What's the process like right now? You're pre-approved. You go to your realtor. Thomas, here's your client. They're pre-approved. This is what they can buy. What's the process like? Walk me through it, please.
Well, my particular process is essentially I understand that this. I try to understand what the client's must-haves are, what are negotiables, and what is not important. There's certain things about a home that you really cannot manipulate. If you're looking for a certain amount of bedrooms, we want to get a certain amount of bedrooms. If you need so many bathrooms, you want to get so many bathrooms. If you want to look for something that has a garage, you might want to get some of the garage. Now, I have some situations whereby, the home buying process is not cookie cutter. Sometimes people will get in there and, they will assume that they will, get pre-approved by a guy like you, and they're going to find the home of their dreams tomorrow. Folks, it's not like that, However, if it's a situation where what I call the cosmetics, you want to pay attention more to the flow of the house. If it's something where you don't appreciate the floors can always be redone. If you don't like the color of the walls, or you don't like the wallpaper, we can always take that back. However, if you're looking for a 3-bedroom and we're looking at a 2-bedroom, that tends to be a little bit tricky. So I try to take my time to understand the client, and every so often, as we're going through the buying process, a lot of these clients are, there's a lot of people in their ear, from family members, colleagues at work, whoever the case may be. Everybody is an expert, but I always try to remind them, you're the one who's going to live in this property. It's your home. You're paying for it. You have to focus on what you're looking for and what works best for your lifestyle and your family's needs.
Amazing. And that's very good, man, because yes, the most important piece is, work with the professional that's going to understand, listen to what your needs are, and then apply it and get you to the closing table.
Correct.
Amazing.
And sometimes, the home buying process is ever evolving. If somebody I bought my first home 20 years ago.
Okay.
And I bought another home 15 or I believe 10 or so years ago.
Okay.
Both these transactions were completely different from how I'm dealing or working with right now. So sometimes you may have a relative or somebody who has been a homeowner forever. but you have to take the information with a grain of salt and refer to your professionals, whether it be your lender or your the realtor, because today's market is completely different from yesterday's market.
That's a very good point, because I get a lot of clients who say, oh, well, somebody that I work with or that I know has the same, scenario as I do, but they bought and I haven't been able to buy, right? Yes, I mean, like you said, every case is very different, right? So there could have been a lot of different factors first that they didn't even share with you, right? They only told you the good things. But then the other thing is, even if you guys are in the same line of work, everybody's going to have a different qualification based off of your own factors.
Correct.
Right? And then going up to the property, when you're working with the professional, the real estate professional, at the end of the day, you're the one that's sweating. You're the one that's going to go into work to work for that money, to pay for your mortgage and to live in it, like you said. So yeah, work with your professionals, and if you hear any advice, I guess, I mean, take it in like with a grain of salt, like you said. Maybe listen to it, but then make sure that you're applying real professional advice and taking it into action. So,
and Sebastian, like I tell all my clients, I do not have all the answers, but given professionals such as yourself and many others that I have in my arsenal of tools, I have a lot of resources.
There you go.
I don't have all the answers. However, I do have resources to arrive to most of our issues.
Amazing. Amazing. Wow, guys. Oh, man, you hear the loud applause and the fireworks? This is amazing, man. This is good. So before we leave these beautiful people go, do you want to leave us with one last piece of advice, one last piece of knowledge, tip? But then more importantly, please, how can we reach out to you, Thomas?
You can reach me at Thomas is my realtor on Instagram. That's the best way to reach out me. And I mean, my only advice and tip is, be true to yourself and be in there with a solid mind. You have all these noises in your ear, but, just be true to yourself, and you're the one that's going to pay for this property and live in this property, not your coworker or your family member for that matter.
Love it. Love it. So get in the home. This is the year. This is the year.
That's right.
Let's go in. So again, Thomas, thank you so much for coming, man.
Likewise, Sebastian.
I appreciate it. And all you beautiful people, thank you so much for tuning in every week. I appreciate it. Please like it, comment, share it, subscribe it, call us, leave us all the questions you want, and we'll talk some mortgages again. Thank you so much.